You don't have $10,000. You don't even have $1,000. You have exactly $100, and you're sitting there wondering what actually happens if you put that same $100 into the market every single month and just keep going. Let's get the disappointing part out of the way first. $100 a month is not going to make you filthy rich. You are not going to end up on a list with Mark Zuckerberg or Elon Musk or Warren Buffett. If that's what you came here for, I'm not going to lie to you about it. But here's what I've learned, and what nobody tells you when you're standing at the very beginning with $100 in your pocket. I used to be a public school teacher. No trust fund, no stock tips, no lucky break. I started small, exactly like this, and I did it with enough consistency and enough stubbornness that I became a millionaire in my 30s. So when I tell you this works, I'm not reading it off a slide. I lived it, and here's the twist you need to hear before we go any further. The $100 was never really the point. The number is almost irrelevant. What matters is the snowball. What matters is the domino you knock over today that you won't even understand the size of for another 10 years. So let's talk about what actually happens, starting the day you begin. Opening the account takes about 10 minutes. You pick a major brokerage, you set up an automatic transfer of $100 on the first of every month, and you point that money at a low-cost, broad index fund that tracks the S&P 500. That's it. That's the entire mechanical setup. 10 minutes and you never have to think about the how again. And I want to pause on why that specific choice matters, because it's the part people skip. A broad index fund isn't a bet on one company having a great year. It's a small slice of hundreds of companies at once, so no single scandal, no single bad earnings call, no single CEO's bad decision can wipe you out. You're not gambling on a winner. You're betting on the entire economy continuing to grow the way it always has, decade after decade, through wars, recessions, and every crisis in between. That's the whole mechanism. It's boring on purpose, because boring is what survives 40 years. The next morning, nothing has changed. Your account says $100. There's no fireworks, no email congratulating you, nothing that feels remotely like the beginning of a fortune. But something invisible just shifted, and it's bigger than the money. You are no longer someone who's planning to invest someday. You are no longer standing on the sidelines watching other people talk about the market like it's a club you haven't joined yet. You are an investor, present tense. That single identity shift is going to quietly rewrite every financial decision you make for the next 20 years, whether you notice it happening or not. Because here's the uncomfortable truth about money. The person who starts today and the person who keeps saying, "I'll start when I have more," are not going to end up in remotely the same place. Not close. And the gap between them isn't created by some dramatic moment. It's created by this exact, boring, 10-minute setup, done or not done. Now, month 6 is where it gets real, because month 6 is where the market tests you for the first time. By then, you've put in $600. And at some point, almost certainly, you're going to open the app and see your balance sitting at $567. You've lost $33. Your stomach drops. Every instinct in your body is screaming that you made a mistake. This is the fork in the road, and it splits people into exactly 2 groups for the rest of their investing lives. Group 1 panics. They sell everything, move to cash, and wait until it feels safe again. But the market doesn't ring a bell when it's safe. So they sit on the sidelines, miss the recovery entirely, and then, driven by pure fear of missing out, they jump back in later at a higher price than they sold at. They've managed to buy high and sell low, which is the single most expensive mistake in investing, and they did it to themselves. Group 2 does something almost boring by comparison. They close the app. They remember they're not investing for 6 months, they're investing for 10 or 20 years. And because they keep contributing automatically, they end up buying more shares while prices are down, which means when the market recovers, and it always eventually does, they ride the entire wave back up, plus everything they picked up on sale. And this isn't a feeling, it's math. If you miss just the 10 best trading days over a 20-year stretch, you can cut your entire portfolio's return in half, not by a little, in half. And here's the part that should terrify anyone trying to be clever about timing the market. Those best days almost always show up right in the middle of the scariest, most chaotic stretches, when everyone else is too afraid to be in the market at all. Now, I know what the skeptical version of you is thinking. This feels like gambling, and what if I need that money right when the market drops? Fair question, and the answer is that this entire strategy only works with money you're not going to need for years. This isn't your emergency fund, and it isn't your rent money. It's money you've decided, in advance, you won't touch for a decade or two, which is exactly what removes the gambling feeling. You're not trying to guess what happens next month. You've already agreed you don't care what happens next month. Here's a question worth sitting with for a second, because I genuinely want to know where you land on this. When you saw that account drop by $33 in month 6, be honest. Would you have closed the app and walked away, or would you have kept going? Tell me which one, and tell me why. because I bet the comments underneath this video split almost exactly in half, and I think the reasons people give say more about them than the number ever could. So let's follow the money year by year, assuming the market does roughly what it's historically done, about 10% a year on average. Year 1, you've put in $1,200 out of your own pocket. Your balance is around $1,265, a $65 gain, underwhelming, almost embarrassing to talk about. That's completely normal, and it's exactly what everyone feels at this stage. Year 5, you've contributed $6,000 total. Your balance has grown to roughly $7,800. That's not just your money anymore. That account is now generating about $65 a month completely on its own, without you lifting a finger. Year 10, $12,000 contributed. Balance around $21,000. At this point, the market is doing more than 40% of the heavy lifting. You are no longer the only one building this. Here's why the curve keeps steepening instead of staying flat. Every year, the fund doesn't just grow off your original contributions, it grows off itself. The gains from year 1 get reinvested and grow again in year 2. The gains from year 2 get reinvested and grow again in year 3. You're not earning interest on your deposits anymore. You're earning growth on top of growth on top of growth, stacked year after year without you doing anything except leaving it alone. That's the entire secret. There's no trick, no special stock pick, no insider information. It's just growth compounding on growth, given enough years to build momentum. Then somewhere around year 8, something happens that changes the entire equation. Total contributions sit around $9,600. The balance is now $14,740. And for the first time, the money the market adds to your account in a single year is larger than the money you added yourself. This is the crossover moment. This is the exact point where your money starts working harder than you do. And then year 30 arrives. $36,000 contributed $100 at a time over 3 decades. The balance, roughly $228,000. For every single dollar you put in with your own hands, the market handed you back another $5.33 on top of it. That's not a straight line. That's a curve that stays flat for a long, long time and then bends upward violently. Almost everyone quits during the flat part, right before the bend. Once people watch this compounding machine actually start running, something else happens. They start noticing their own spending differently, not out of guilt, just out of math. If you bump your contribution up to $300 a month, about $10 a day, that 30-year outcome jumps to somewhere around $680,000. Push it to $500 a month, $16 to $18 a day, and you clear a full million, closer to $1.14 million. None of this requires you to earn more money before you start. It requires you to open the account this week. Log into your brokerage, look for the recurring or automatic investment setting, confirm the fund you picked charges close to nothing in fees, and make sure any dividends the fund pays out are set to automatically reinvest instead of sitting in cash. That one setting, dividend reinvestment, is quietly doing a chunk of the compounding work in the numbers we just walked through. Skip it, and you leave growth on the table without ever noticing. But here's the number that should actually keep you up at night, more than any of the growth charts. It's not how much you invest, it's when you start. A 25-year-old who puts in $100 a month for 30 years contributes $36,000 total and ends up around $228,000. Someone who waits until 35 to start has to invest $300 a month, triple, just to land on that exact same $228,000 by age 55. 10 years of waiting doesn't cost you 10 years. It costs you triple the money forever just to catch up to where you could have already been. Follow that forward one more step. The 25-year-old isn't just ahead at 55. They got there while writing a check that's a third the size every single month for their entire working life. That's 10 years of extra vacations, extra breathing room, extra money that could have gone anywhere else, all spent instead closing a gap that never had to exist. The 10-year delay isn't a pause. It's a bill that quietly gets more expensive every year you don't open the account. The biggest change, though, isn't the number on the screen. It's what happens in your head. You start understanding what it really means to pay yourself first. You realize the most important bill you owe every single month isn't Netflix, and it isn't whatever showed up in an Amazon box this week. It's the bill you owe to the person you're going to be in 20 years. And unlike every other bill you pay, this one doesn't disappear the moment you pay it. It goes to work immediately, on its own schedule, without asking your permission or checking in with you first. Every dollar becomes a choice. It either gets spent and vanishes forever, or it gets put to work and starts duplicating itself while you're doing literally anything else with your time. Putting $100 a month into the market is the only class where, instead of paying tuition to learn, the market pays you to sit in the seat, and your net worth grows while you're still learning the lesson. But here's the flip side nobody shows you. The person who never opens that account doesn't get a dramatic ending either. They don't lose $33 in month 6. they never feel the test at all because there's nothing to test. And by year 30, they haven't just missed out on roughly $228,000. They've spent 3 full decades quietly trading real money for absolutely nothing, a little at a time, without ever once deciding to. So go back to where we started. You don't have $10,000. You don't have $1,000. You have exactly $100. Except now you know that number was never the story. It was never supposed to be the story. That $100 was just the first domino. And the only question left is whether you're the kind of person who lets it fall, or the kind of person who's still standing there, staring at it, calling it small.